For generations, the U.S. housing market has been the cornerstone of wealth building, the foundation of the middle class, and the ultimate symbol of the American dream. Buying a home wasn't just about four walls and a roof. It represented financial stability, long-term security, and upward mobility. But today, that dream is slipping out of reach for millions of Americans. Home prices have soared to record highs, while wages have failed to keep up. After years of historically low interest rates, mortgage rates have more than doubled, pricing many buyers out of the market. And now, the cracks are becoming impossible to ignore. Experts warn of an impending housing market correction, and in some areas, the early signs of a housing bubble collapse are already flashing bright red. Families who bought at peak prices are now struggling to keep up with monthly payments. Real estate investors are backing out of deals as profit margins shrink. Entire states that relied heavily on rapid real estate growth could soon face a major economic slowdown. The coming correction won't affect every region equally. Some states are far more vulnerable than others. From overheated markets to unsustainable price booms, these are the areas most at risk of a housing market crash. Before we dive in, make sure to subscribe to Nest Abroad channel. We deliver in-depth analysis on the housing market, U.S. economy, and real estate trends, helping you stay ahead of the next big shift. Now, let's count down the 10 states where the housing market bubble is likely to burst first and hardest. Number 1. Florida. A housing market at its breaking point. Florida has long been one of the hottest and most volatile housing markets in the U.S. Miami, Tampa, and Orlando became magnets for investors, retirees, and out-of-state buyers fleeing high-tax states. Developers rushed to build luxury condos and gated communities, driving home prices far beyond what local incomes can support. But beneath the boom, Florida's housing market is showing serious cracks. Home insurance costs have skyrocketed, with many premiums now rivaling or exceeding monthly mortgage payments. Major insurers have left the state due to hurricanes, flooding, and rising sea levels, leaving homeowners struggling to find coverage. Without affordable insurance, thousands of homes risk becoming unlivable or unsellable. Meanwhile, inventory is climbing and sales are slowing. Homes and condos that once sold in days now sit on the market for months. Builders who overbuilt during the pandemic boom are facing unsold supply, forcing price reductions across the state. Even Florida's rapid population growth, often seen as a safety net, may not be enough to sustain demand. As affordability collapses and climate risks escalate, potential buyers and investors are hesitating. Rental yields are shrinking, costs are rising, and the math no longer works for many landlords. Florida has weathered housing crashes before, but experts warn this time the risks are structural, not just cyclical. If the housing bubble bursts, the Sunshine State could face one of the steepest market corrections in the country. Number 2. California, the housing market on the edge. California has long symbolized both opportunity and excess, and its real estate market is no exception. From Los Angeles to San Francisco, median home prices exceed $800,000, while wages for most workers remain stagnant. For millions, home ownership is out of reach, fueling frustration and driving residents to more affordable states like Texas, Arizona, and Idaho. For years, tech wealth and foreign investment helped California's market defy gravity. But now, cracks are spreading. Remote work has hollowed out downtown districts, leaving office towers partially empty. Tech layoffs at companies like Google, Meta, and Salesforce have cooled demand, and even wealthy buyers hesitate amid rising interest rates. Luxury condos that once sold instantly are now lingering unsold. Builders are slowing new projects, and developers warn that financing is tightening. Meanwhile, homelessness has surged, highlighting the human and economic strain caused by sky-high housing costs. California's market is uniquely significant. It is the largest housing market in the U.S., meaning a major correction could ripple across banks, pension funds, and global investors. Unlike other states, the Golden State's housing bubble is massive, entrenched, and detached from local incomes, making it particularly vulnerable. If California's housing bubble bursts, the effects won't be confined to the state. It could reshape the U.S. housing market and broader economy, sending shockwaves nationwide. The stakes are higher here than anywhere else, and the next downturn could be historic. Number 3. Texas. From affordable haven to housing bubble. Texas has long been celebrated as the land of affordability and opportunity, but that image is fading. Austin, once the crown jewel of tech migration, has become one of the most overvalued housing markets in the U.S. Home prices doubled in under a decade, fueled by remote workers, investors, and companies relocating from California. Now, what was once a boom is showing signs of a bubble. Home sales are slowing, inventory is rising, and price reductions are accelerating. In Austin, properties that once sold above list price are now seeing 10 to 20% markdowns, while Dallas and Houston face similar affordability challenges. The speculative frenzy that drove rapid appreciation is reversing. Homeowners who bought at the peak risk going underwater, and investors are pulling back from risky developments and flips. Even Texas's strong job growth and population inflows cannot offset the fundamental problem. Wages have failed to keep pace with soaring housing costs. Builders are slowing projects as unsold inventory accumulates, signaling that the market may be approaching a correction. The state's housing bubble is no longer just about high prices. It's a test of whether Texas can continue delivering on its promise of affordability and economic opportunity. If the correction deepens, the impact could be severe, reshaping neighborhoods and challenging the narrative of Texas as a stable, affordable housing market. For a state built on growth and opportunity, the coming housing adjustment could redefine its economic identity. Number 4. Washington. Seattle's overheated housing market. Washington's housing market, centered on Seattle, has long been fueled by tech-driven wealth. Amazon, Microsoft, and a booming startup scene pushed home prices to record highs, making Seattle one of the most expensive cities in the U.S. For years, homeowners enjoyed unprecedented gains. But the same tech engine that powered the boom is now threatening to unravel the market. Tech layoffs and hiring slowdowns are spreading. Amazon has curtailed hiring, Microsoft has trimmed thousands of jobs, and venture-backed startups are folding under tighter capital markets. Remote work is now permanent for many, leaving downtown Seattle office towers half empty and dragging local businesses down with them. Housing fundamentals are weakening. Seattle remains heavily overvalued, with home prices far exceeding local incomes. Inventory is climbing, bidding wars have vanished, and sellers are increasingly offering steep price cuts. Historic high mortgage rates are pushing even more buyers out, intensifying the slowdown. Beyond economics, social and quality of life issues are adding strain. Homelessness has surged, crime is more visible, and rising costs are driving families to Idaho, Montana, and other neighboring states, increasing housing overhang and market pressure. Washington's reliance on tech makes it uniquely vulnerable. If the industry contracts further, the ripple effects could devastate the housing market, local economies, and public finances. Seattle's housing bubble is fragile, and a market correction could erase years of gains almost overnight, positioning the city as one of the most at-risk areas for America's next housing collapse. Number 5. Oregon. On the brink of a housing collapse. Oregon's housing market is teetering on the edge, with warning signs flashing red. Portland, once celebrated for affordability and livability, is now one of the least affordable cities in the nation. During the pandemic, home prices surged as California migrants and investors drove demand, treating Oregon as the next frontier for real estate wealth. Now, the frenzy has cooled, leaving a fragile, overpriced market on the verge of collapse. Portland faces a triple threat of rising crime, visible homelessness, and persistent outmigration. Families and young professionals are leaving, reducing demand while inventory continues to build. Homes that once sparked bidding wars now linger unsold, even after multiple price cuts. Investors are pulling back, and new construction projects are being delayed or canceled due to high costs and shrinking demand. Financing has dried up, leaving unfinished developments as stark reminders of a market pushed too far. Beyond economics, Oregon suffers from a reputation shift. Once seen as an affordable alternative to California, it is now viewed as overpriced, unstable, and socially strained. This perception fuels further out migration and erodes confidence, creating a feedback loop that drives prices even lower. The convergence of overvaluation, weak wage growth, investor retreat, and declining livability makes Oregon uniquely vulnerable. If the housing bubble bursts, the state could experience one of the deepest and most rapid market corrections in the U.S., positioning Oregon as the #1 at-risk state in America's next housing collapse. Number 6. Idaho, America's most overheated housing market. Idaho's housing market has become one of the nation's clearest real estate cautionary tales. Once known as one of the most affordable states in America, Idaho saw a massive migration wave during the pandemic. Boise became the epicenter of the frenzy, attracting Californians and out-of-state buyers seeking cheaper homes and a slower pace of life. But the surge pushed home prices up more than 60% in just a few years, making Boise one of the most overvalued housing markets in the country. Local wages haven't kept pace, leaving many longtime residents priced out and new arrivals questioning whether Idaho's cost of living is worth it. Now, the market is cooling. Home sales are slowing, inventory is rising, and price cuts are becoming widespread. Properties that once sold in bidding wars now sit on the market for months. Much of Boise's boom was driven by speculation, investors betting on endless appreciation. But as mortgage rates climb and demand weakens, that speculative buying has dried up. Builders are responding by scaling back new construction projects, signaling that even developers see trouble ahead. Without significant wage growth to justify today's prices, Idaho's market looks dangerously stretched. While population growth may continue, housing affordability has collapsed, and the market has likely reached its tipping point. If the housing bubble bursts, Idaho, and especially Boise, could face some of the sharpest price declines in the nation. Number 7. Colorado, from boom to breaking point. Colorado's stunning landscapes and booming cities have made it one of the most desirable states in America, but that popularity has come at a cost. Denver, Boulder, and Colorado Springs are now among the least affordable housing markets in the country, with prices soaring far beyond what the average household can afford. During the pandemic, remote workers from high-cost states flooded Colorado, driving demand to record levels. Home values surged, bidding wars became common, and new construction raced ahead to meet demand. But now, the tide is turning. Mortgage applications have plunged, homes are sitting on the market longer, and sellers are slashing prices that would have been unthinkable just a few years ago. In Boulder, million-dollar homes that once sold overnight are lingering unsold. In Denver, many families are spending nearly 50% of their income just to cover housing costs. Adding to the pressure, property taxes and insurance premiums are climbing sharply. Colorado's exposure to wildfires and hailstorms has led insurers to raise rates or pull out entirely, making homeownership even less affordable. Meanwhile, builders who rushed to meet pandemic demand are now facing a glut of unsold inventory, putting more downward pressure on prices. The parallels to 2008 are hard to ignore: overvaluation, speculative development, and rising debt loads. If the U.S. economy slows or unemployment rises, Colorado could face one of the steepest housing market corrections in the nation, turning a boom into a painful bust. Number 8. Arizona. A housing bubble ready to burst. Arizona has experienced a housing crash before. During the 2008 Great Recession, Phoenix was one of the hardest-hit cities, with foreclosures wiping out entire neighborhoods. Today, warning signs suggest history may be repeating itself. During the pandemic, Phoenix, Scottsdale, and Tucson became some of the fastest-growing housing markets in the nation. Home values nearly doubled in less than a decade, bidding wars became routine, and investors bought up properties in bulk. Locals were quickly priced out as demand surged. But Arizona's housing market fundamentals are weak. Median incomes are below the national average, and wages have not kept pace with rising home prices. With mortgage rates doubling since record lows, thousands of buyers have been forced out of the market. Now, sales are slowing, inventory is climbing, and price cuts are spreading across Metro Phoenix. The rental market is softening as well. Vacancies are rising, rents are stagnating, and investors are selling off properties, putting more downward pressure on prices. Long-term risks make Arizona especially vulnerable. Severe water shortages on the Colorado River threaten future development and agriculture, key pillars of the state's economy. Population growth, once a major driver of housing demand, is slowing, leaving the market overextended. With affordability collapsing and demand weakening, Arizona's housing boom is looking more like a bubble. If conditions continue to deteriorate, the state could once again be at the center of a major U.S. housing market correction. Number 9. Utah. From housing hotspot to market correction. Utah's housing boom has been one of the fastest in the nation. Once known for its affordability, family-friendly culture, and strong economy, the state became a magnet for tech workers and families fleeing high-cost states. Salt Lake City, Provo, and Ogden saw home prices double in less than a decade, turning Utah into one of the hottest real estate markets in America. But what looked like unstoppable growth has now reached a tipping point. Inventory is surging as sellers rush to list homes while buyers pull back under the pressure of rising mortgage rates. Salt Lake City, once a top-ranked housing market, is now leading the nation in price cuts. Properties that once sold in bidding wars are sitting on the market for months, with slashed prices and fewer offers. The fundamentals no longer support Utah's inflated home values. While the tech sector remains strong and unemployment is low, median household incomes cannot keep pace with today's prices. Investors who bought during the boom are retreating, adding even more supply to the market. Builders who once raced to keep up with demand are now slowing or halting projects as unsold inventory piles up. Utah's population growth will continue, but growth alone can't sustain overvalued home prices. If interest rates stay high or the economy slows, Utah could face one of the sharpest and fastest housing market corrections in the country, a dramatic shift for a state once seen as a model of economic stability. Number 10. Nevada. America's most vulnerable housing market. Nevada has always been a state of extremes: booming cities, high stakes, and sudden downturns. Over the past decade, Las Vegas and Reno became hotspots for migration, attracting Californians and remote workers seeking affordability and a fresh start. But that explosive growth came at a cost. Home prices skyrocketed. In Las Vegas, the median home price jumped nearly 40% in just a few years, while Reno saw even steeper increases. The problem? Wages haven't kept pace. While out-of-state buyers and tech workers drove demand, most Nevada residents are struggling to afford homes. Adding to the risk is Nevada's volatile, tourism-driven economy. When the pandemic hit, unemployment soared to nearly 30%, the highest in the nation. A slowdown in visitors means lost jobs, unpaid mortgages, and rising foreclosures. Today, with consumer debt at record highs and recession fears growing, cracks are showing. Homes that once sold in days now sit on the market for months. Investors, who bought thousands of homes during the boom, are pulling out and listing properties, putting even more downward pressure on prices. Water scarcity is another looming threat. With the Colorado River at dangerously low levels, growth could slow, further cooling demand. Nevada's housing market is overvalued, overbuilt, and vulnerable. If the housing bubble bursts, the Silver State could once again be ground zero for a U.S. housing market crash. Homeowners, investors, and entire communities may face losses that take decades to recover. From Nevada's speculative boom to Oregon's fragile foundation, these 10 states show just how unstable America's housing market has become. The question isn't whether the bubble will burst. It's how soon and how devastating it will be. Some states may weather the storm, while others could see entire local economies reshaped. One thing is certain: the era of endless home price growth is over, and the new reality will be far harsher. So, what does this mean for you? Are you ready to protect your investments and make sense of the changing market? Subscribe to Nest Abroad channel, hit the like button, and activate the bell so you never miss a breakdown. We release new videos every day at the same time, keeping you informed and ahead of America's housing story, one state at a time.